Hello, and welcome to our Q4 update from the Asia trade floor. Today, we are delving into a pivotal moment for the Chinese economy and what it means for investors. Chinese policymakers are facing the challenge of stimulating growth without resorting to the often used credit field expansion, given the elevated level of debt. In late September, the People's Bank of China cut policy rates more than expected, reduced banks' reserve requirement ratios, lowered mortgage rates and minimum down payment ratios for home purchases, and created new facilities to channel capital directly into equity markets. About 3 weeks later, the Ministry of Finance signaled its readiness to significantly boost fiscal spending. It announced a one-time large-scale expansion of a debt swap program. The aim is to refinance off-balance sheet debt or hidden debt accumulated by local governments through various financing vehicles. This should alleviate financial pressure and free up cash for essential expenditure, including infrastructure projects. For investors, this situation calls for a measured approach. The recent policy stimulus is a positive for sentiment and technicals, likely boosting asset prices in the near term and potentially leading to increased inflows into Chinese assets. If bearish sentiment diminishes, we could see further spread compression in China credits and high beta Asia credits, as well as in frontier markets like Pakistan. However, we remain cautious about whether this represents a true structural turnaround. Additional easing is needed to achieve a sustainable recovery and address ongoing issues such as weakening household demand and depressed asset prices. While the announced measures are a step in the right direction, we will closely monitor upcoming fiscal policy announcements. We expect China's growth to slow to 4% to 4.5% in 2025, down from 5% in 2023 and 2024, and anticipate continued deflationary pressure that could impact other regional economies. Looking further ahead over the next 3 to 5 years, the evolving composition of China's economic drivers will significantly affect global trade relations and the broader economy. As the country shifts from debt-fueled growth to higher quality growth focused on innovation and sustainability, new winners and losers among sectors and asset classes will emerge. As we assess these developments, it is prudent for investors to consider diversifying their portfolios, as other emerging markets are showing more promising growth trajectories and may offer more attractive opportunities. India presents a compelling opportunity for investors, especially as capital shifts away from China. The country has shown strong economic resilience with a robust IPO cycle and increasing foreign investments. The ongoing structural reforms and government initiatives aimed at boosting infrastructure and consumption further enhance its attractiveness. While China's growth is expected to slow, India is expected to maintain a higher growth trajectory, with estimates suggesting low double-digit nominal growth. This positions India as a more favorable destination for investments, particularly in sectors like technology, consumer goods, and infrastructure. As global investors seek diversification, India's rising prominence in major indices is likely to attract further inflows, making it a key market to watch. In our latest published outlook for the next 6 to 12 months, we highlighted other emerging markets that present opportunities. These include South Africa and Peru, where yield curves are steep and political conditions are stable or improving. Turkey also remains of interest given the ongoing pivot to greater economic autarky. Overall, as developed economies slow and potential trade and geopolitical conflicts loom, we believe investors should favor caution and flexibility in portfolio positioning. As central banks lower short-term rates, we expect yield curves to steepen, creating a favorable environment for fixed income investments.